Amidst all the chaos of the market, the big players, they leave a trail. And no, I'm not talking about random price wiggles. I'm talking about actual footprints. And today, we're going to learn how to read them, to spot the imbalances that can literally signal the market's next big move.
I mean, what if you could actually see the exact moments when institutional money floods the market, moving it so fast that it literally leaves a gap behind? Well, those gaps are the story. They're telling us exactly where the market has been inefficient, and you know what's even more important? They're hinting at where it might just need to come back.
Okay, so our story begins with the most fundamental clue you can find on a chart. It's a concept called the fair value gap, and it's really the basic building block for understanding all these powerful market inefficiencies.
So what exactly is a fair value gap, or FVG for short? Well, think of it like this. It's a price imbalance. It's what happens when one side of the market, let's say buyers, comes in so strong that the price just shoots up, completely skipping over certain levels. It leaves behind this vacuum, and that's a crystal clear sign of big institutional force making its move.
And the best part? The signature for this pattern is actually super simple. It's all about a three-candle formation. First, you get a strong candle kicking off a big move. Then, the second candle just keeps that momentum going aggressively in the same direction. But here's where the magic happens. It's the third candle that confirms the gap, leaving that clear void between its wick and the wicks of the very first candle. That space is what we're looking for.
Okay, now this is the most important rule, so listen up. For a gap to be a valid FVG, the wicks of that first and third candle cannot, I repeat, cannot overlap. If they touch, it means the market has already traded efficiently there, so no gap. But if you see that clear, empty space between them, bingo. That's the imbalance we're hunting for. That little void is everything.
Here's a pretty good way to picture this. Think of a courier truck that's in such a hurry it just speeds past a few of its deliveries. Sooner or later, right, it's got to loop back to finish the job. The market is a lot like that. These gaps act like magnets, almost pulling the price back to rebalance the books and fill in those missed spots before it decides where to go next.
All right, so we've got a handle on a single imbalance, the FVG. But what happens when two of these powerful moves, one screaming up and another one screaming down, collide with each other? Well, that collision creates a totally new pattern, and it's called the balanced price range.
So, a balanced price range, or BPR, is basically a zone where the market just chills out for a bit. It finds a temporary equilibrium. I like to think of it as a negotiation room. Buyers and sellers have finally agreed on a temporary fair price, and everything just pauses. And the way you see this on the chart, it's two overlapping fair value gaps.
So, how does one of these things actually form? Well, the story starts with something we already know. You get a powerful, impulsive move that creates an imbalance. Let's say in this case, buyers are just completely in control, leaving behind a big bullish fair value gap.
But then, the tables turn, the market reverses, and a strong move in the opposite direction carves out its own FVG, this time a bearish one. And it forms right back inside the territory of the first gap. So now, you've got these two opposing forces meeting head-on. And right there, when those two gaps overlap, that is the magic moment. The intersection of that bullish FVG and that bearish FVG is what creates this zone of consolidation. Suddenly, the market isn't imbalanced anymore. It's found equilibrium. And that, right there, is your balanced price range.
Okay, so spotting these zones is one thing, right? But actually trading them, that's a whole other ballgame. So how do we take this knowledge and turn it into a strategy we can actually use? Let's break it down.
Honestly, the core idea here is really simple, almost elegant. When you see a fair value gap, you're looking at pure imbalance. So the most likely play is that price is going to retrace to fill that gap. Simple. But when you spot a balanced price range, you're looking at equilibrium. The game changes. Here, the strategy is to wait for things to consolidate and then get ready to trade the breakout.
But hold on. Before you jump in and trade any breakout or retracement, please remember the golden rule. Risk management. I don't care how perfect a setup looks. Professionals, the ones who last, they typically risk only 1 to 2% of their capital on a single trade. And that discipline, that's what separates a real trader from a gambler. End of story.
Now, these patterns are definitely powerful all on their own, but they become true high-probability signals when you find them working together with other things, when they don't just appear in isolation. So let's talk about how to combine them to build a much stronger strategy.
The secret ingredient here is something called confluence. It's just a fancy word for looking for multiple signs that are all pointing to the same conclusion. Ask yourself questions like, does this fair value gap show up right at a level where price has bounced hard before? Or does the breakout from this balanced price range happen exactly when the bigger trend is starting to shift? When you see a few of these different clues all lining up, man, your confidence in that trade should go way, way up.
All right, let's do a quick recap of the most crucial points. First, the fair value gap, the FVG. That's your three-candle imbalance. It's a sign of inefficiency, and it acts like a price magnet. Then you've got the balanced price range, the BPR. That's what you get when two of those FVGs overlap. It creates a zone of temporary balance, a calm before the storm.
And that really just leaves us with one final thought, doesn't it? Are these patterns some kind of predictive map to the future? Or are they just a really clear reflection of the past? You know, maybe the real skill isn't just in seeing the footprints. Maybe it's about understanding which way they're about to turn next. At the end of the day, the chart is a story. And now, you've got two brand new ways to read it.